Hey guys, so in today's video, we're gonna go over renting versus buying. Does it make sense to rent or does it make sense to buy? How long should you rent for before you start looking to buy? We're gonna interview my accountant. Of course, I wanna sell property because I get a higher commission instead of renting, but I always have my client's best interest at heart. So today we're gonna sit down with my accountant, go over the data, and actually give you the numbers. Before we go over the data, I'm gonna show you guys this apartment for 1.2 since that's the median sales price in New York City. So let's come check out this apartment. All right guys, so we're gonna check out, I think this is a 2-bedroom, $1,245,000. If you guys are looking for real estate, the Compass app is probably it's probably the best website and app. Since this is a co-op, this building mandates that you do 35% down. The monthly maintenance is $2,000 and your projected monthly payment based on Compass, $7,620 per month. There's no additional taxes because it is a co-op. If you guys want to see the condo versus co-op, I'm going to drop the link down below because I covered the difference between condo versus co-op. New York City is known for co-ops. Shout out to Ron Harvey, my colleague right here. This is his listing. But this apartment was recently renovated. This is the kitchen here. This apartment doesn't have laundry inside, but there is a dumbbell situation. So like these older buildings, they used to actually deliver food and mail through this dumbwaiter here. So you could actually turn that into a laundry situation. This is the primary bedroom. I actually love the closet situation here. You have a his and hers closet, or his and his, or hers and hers. Nice windows here. So you're actually facing south. Co-ops, they typically don't list the square footage, so I don't know how much square footage it is, but if I had to guess, it probably would be around 1,000. What do you like about this listing?
Oh man, I love the charm of the apartment. There's just the perfect amount of, just that pre-war accent, the sconces, the crown molding. Yes, it's a cozy apartment.
Yeah,
charming.
And it's move-in ready too. So you guys, all you have to do is bring your toothbrush, toothpaste, luggage, and that's it. So what do you guys think? Comment below. Would you live here for 1,245 with a $7,620 monthly payment? Let me know. So what do you guys think about that apartment? Would you live there? Let me know in the comments. We're heading back to the office. I'm gonna interview my tax guy. It's kind of weird walking backwards in New York City. Don't want to get hit by a car or a city bike these days. But yeah, so we're gonna head back, interview my accountant, David Cologne. I've known David since he was like 17. He actually grew up in the business. His stepdad was an accountant. So just interesting to hear his take. Like, when does it actually make sense to buy versus rent? Buying property is it's not the smart decision for everyone. So usually I just want to advise my clients on what's best for their goals, right? All right, guys, so I got my friend and accountant, David Cologne. I've known, like I mentioned earlier in the video, I've known David since he was like 17 years old, or I don't know, it was over 10 years, but he grew up in the business. His stepdad owned an accounting firm that did taxes for people. David's done my taxes, I don't know, many years at this point. Saves lots of money. So we're going to go over the benefits of buying versus renting from the accountant's perspective. We're going to go over what's tax deductible and what's not tax deductible, right, from both the buying and renting. So let's go over renting first. So 70% of New Yorkers rent in New York City. So if someone rents, right, at the average rent of $5,200 per month, what's tax deductible?
First off, Justin, thank you for having me on. It's a pleasure to be here. Okay, so as far as renting, there's not many angles you can use as a tax deduction, especially when you're just using it as a place to live, to lay your head. Now, if you're conducting business through, let's say, your apartment or your home, there is a home office deduction that you can apply to your taxes.
So basically someone renting for $5,200 per month, right? So with their security and paying, 12 months of rent, that's $67,600. So you're saying none of that money is tax deductible?
Only up to the use of your home office for your business. For the home office deduction, you need to take the total square footage of the area that you're using exclusively and regularly for business. So just to make numbers easy, let's say you have a home that's 100 square feet and your home office is 10 square feet. We're talking 10% of the home is used for your home office.
So, but what about the person that's not self-employed, which is most people in New York City? I mean, there's a lot of people that buy property that are not self-employed that work, they work for someone. They get a W-2. We call it the W-2 income, right? Yeah. Can deduct any rent?
Basically, the short answer for renters, there's really not many angles you can use to deduct your home on your taxes.
So essentially, you're throwing your money away in the garbage.
Essentially, yes.
Now let's flip it, right? So let's flip it to the average sale price in New York City. We calculated the average sale price based on Compass was around $1.2 million. So what's the benefit of owning a home?
The tax code has numerous incentives for a homeowner. One of them being the mortgage interest deduction. Do your itemized deductions, you're able to deduct the interest that you're paying for your mortgage as a tax deduction.
So we calculated based on calculated.net amortization calculator. So we'll drop that link below. But based on a 1.2 purchase price, you're going to put down 20%. So your mortgage, your loan is actually going to be around $800,000, right? So we calculated the first year mortgage interest at around $52,000, and we'll share that those calculations below.
The $52,000 in mortgage interest would be tax deductible.
So to qualify for a 1.2 purchase price with 20% down, you have to make around $200,000 a year, like $200,000 to $215,000 a year. How much of that $200,000 is taxable in New York City?
How much of the $200,000 that you made as your revenue?
Call it as a W-2 employee.
Depending on the deductions and the credits you qualify for, you're going to be somewhere between 40 and 50% tax bracket.
Basically, if we spent $5,200 in rent, $67,000 in the first year is not tax deductible. But if we purchase a $1.2 million property, which is the average sales price in New York City, $52,000 is tax deductible. Okay, got it. All right. Well, now what about real estate taxes? So only $10,000 of real estate taxes are tax deductible?
Yeah, and this really hurts a lot of homeowners because their state and local taxes, which include the property taxes that they pay on their property, is capped at $10,000 as an itemized deduction.
So if I make $200,000, does it, like, can I get that $10,000 credit then?
So if you're making $200,000, it's not, and this is where certain confusions come inside the realm of taxes. People confuse credits and deductions.
Okay, so what's the difference?
So deductions reduce your taxable income. Credits give you a dollar for dollar amount that you pay. Now, there's some credits that are refundable that give you more in your refund, but then there's some credits that just solely reduce your tax liability.
So far with the scenario, it makes more sense to buy versus rent, even if it's for the first year. So let's talk about after you actually close the property. So once you close on the property, right? Let's talk about like maintenance, repairs. We already touched on property taxes, but let's talk about property insurance. Is anything tax deductible from that aspect, from owning a home as a primary residence?
So if you're making, let's say, solar upgrades or energy efficient upgrades, there are tax credits. Up to 30% of the cost of those upgrades can be applied to your taxes as a tax credit.
Basically, no, if it's my primary residence.
If it's your primary residence, no, unless you're operating your business through your residence.
So let's talk about my case, right? So like I own multifamily building. So if I own a multifamily building, just say, let's call it a 2-family, right? Because we actually sell a lot of 2-family townhouses like in Brooklyn, Manhattan, and I have a tenant, right? Is anything tax deductible from that standpoint?
Absolutely. The advertising that you do to get the tenant, if you're paying If you're paying, in some leases, the owner pays the utilities, if you're paying the utilities, but also you got to think about the maintenance. If you have someone come in to clean the property, around the property, trim the leaves, cut the grass, rake the leaves, shovel the snow, all of that is tax deductible. Whatever is used for the business ends that's going to benefit your tenant is going to be tax deductible. But the real king, when you have multifamily properties or investment properties in general, depreciation is your best friend. Depreciation is a deduction against the revenue that you're generating. And that's through a span, let's say if you're talking a personal residence, that's for a span of 27 and a half years that you have that deduction. What's great about having an investment property, a way that you can avoid capital gains, is through a 1031 exchange.
How much of the $1.2 million can you depreciate?
Depreciation is going to be the purchase price minus the land value. Let's say the land value that the structure sits on is, let's say, $50,000. Then, the 1.2 million minus the 50,000 is the difference of that is what you can depreciate over the 27 and a half years. And the beautiful thing about depreciation is that you can do something that's called a cost segregation study. A cost segregation study is a way for a professional to come in, break down all the aspects of your property to try to accelerate the depreciation so that you can get a higher deduction in the earlier years after you purchase the property.
Let's talk about capital gains, right? Capital gains is basically if you buy that $1.2 million property, right? But I sell it for 1.5. Capital gains is I'm basically getting taxed on the profit. When do I have to pay capital gains if I'm selling for a profit?
In order to qualify for the exemption of the capital gains, that would have had to have been your primary residence for 2 of the last 5 years. You can qualify up to $250,000 filing as single, or up to $500,000 capital gains exemptions if you're married filing jointly.
What if I didn't live there? What if I lived there just for 1 year and I had to move out of the city because I took a job somewhere else outside of New York City, and I need to sell this property? Like, I'm cash strapped. Like, how much taxes I have to pay on that profit?
You bought it for 1.2, so that's about $300,000 of capital gains that you're gonna have to pay taxes on. If it's short term, so a year or less, then you're gonna pay at your normal ordinary tax rate, which in the scenario we spoke about would be around, anywhere from 40 to 45%.
Let's do another scenario, right? What if I bought the property for 1.2 and I needed to sell after year 3, even though I only lived there for a year because I had to move out the city, like I just mentioned, right, for another job, and I rented it out. But now my property's worth $1 million.
Right.
So I'm losing money now, right?
Money.
Is there any tax deductions on that?
It's your primary residence. It was turned into an investment property.
Yeah, because I had to move out the city.
Obviously, there's going to be a loss, and you're going to be able to carry over that loss. So it's going to be $3,000 a year that you're able to offset your income with, and then you just carry that forward until the loss is completely used up.
So it sounds like to me I carried $3,000 up till I reached that $200,000 for the rest of my life.
If that's how long it takes, then yes.
All right, Dave, thanks for answering all the questions. We're going to drop your info below. If anyone is interested in tax advice, hit my guy up, David Colon from Better Tax.
Thank you so much, Justin. It's been a pleasure.
All right, guys. So based on the conversation with David yesterday, we learned a lot of things. And if you have any specific questions, comment below. I thought going into the conversation that renting might make sense, maybe a year or 2, but the numbers show that it doesn't make sense at all. If you don't have the money to buy, then you have to rent. So yesterday we covered upfront costs for renting. It's gonna cost you $72,000. I think I quoted a lower number. None of that is tax deductible unless you are self-employed, and approximately about 10% of that would be tax deductible based on square footage. Out of that $72,000, it's potentially $6,000 of that would be tax deductible. However, when you purchase a property, and we're going again on that 1.2 sale price, Your upfront costs for the first year is $367,000. The $276,000 of that 367 is down payment and closing costs. So 20% down payment. That's something you could, we're gonna put the figure, I don't have the calculator in front of me, but that could be built in equity, right? So when you sell in the future, if you don't claim a loss, you get that money back. So hopefully your property doesn't get devalued by 20%. First year of maintenance and mortgage payments is around $91,000 approximately. Again, we're going based on the 1.2 property. We're going based on that maintenance of that property you saw yesterday, which is $3,500 of maintenance. It's, you know, it's kind of typical in New York City, but basically $56,000 of that $91,000 is tax deductible. So if you have the money to buy, it makes sense to buy and not to rent. Even if you're going to move out the city a year later, because you could potentially rent it out and still get some tax benefits based on what we learned from David. Then we also learned from David that if you get like a multifamily and you live in one of the units and you rent out the other unit, there are a bunch of tax deductions that you can get based on utilities, maintenance, cleaning, landscaping, anything that can affect the tenant. And then the big thing was depreciation. So you could depreciate the property for 27 and a half years. So I hope all this breakdown and my conversation with David made sense. If it didn't make sense, again, comment below. But thank you guys for watching. Like this video, subscribe to this channel, and I'll see you guys next week.